the thing that is fantastic about rental income is I'm going to air quote it, it's sheltered, right? It's not like a tax shelter per se. That's not what I mean by that. But if you're earning income, rental income, and you've got expenses, you're allowed to take those expenses against that rental income, including things like depreciation. Now, this can mean you can bring that rental income all the way down to zero, and then it's basically tax-free money, right? Yay.
Hi, I'm Bette Hochberger, CPA, CGMA. This channel covers tax strategies and preparation, real estate finance, and more. Come learn how to grow your business and keep your wealth.
Today, we're going to do a little beginner's guide to rental income. So, the first thing you have to understand, and this is super, super important, is that rental income is considered passive income by default, right? So what does that mean? Well, if you have a W-2 job, say, or you own a business, you have what we call non-passive income. Rental income, on the other hand, is considered passive. Now, they have different names, and I like to think of them as being in different buckets. Passive, non-passive, they do not touch each other. They're in separate buckets. They don't wash out at all. So if you're buying a rental property thinking, oh, if I have any losses, I can offset my income, that might not be true, right? And it happens a lot that someone comes in to do their taxes and they find out, oh, I had all these losses on my rental property. What happened? Where did that go? Why do I still owe so much tax? And the reason is that rental income is generally considered to be passive. Now, passive income is fantastic, but passive losses, on the other hand, most of the time don't offset your other non-passive income. It ends up getting suspended, carried forward, and it can be used later. It's not gone forever, but it doesn't necessarily help you in that year. And that's a hard concept for a lot of people to understand. So passive income is fantastic from a wealth building perspective, right? You're doing something where you're getting paid and you're not paying, you're not like having to work and spend your time because it's a rental property and it's just generating money in your sleep, right? Those are all fantastic, but it doesn't help you offset your W-2 income most of the time. There are exceptions, right? We'll talk about a couple of those. Now, the thing that is fantastic about rental income is I'm going to air quote it, it's sheltered, right? It's not like a tax shelter per se. That's not what I mean by that. But if you're earning income, rental income, and you've got expenses, you're allowed to take those expenses against that rental income, including things like depreciation. Now, this can mean you can bring that rental income all the way down to zero, and then it's basically tax-free money, right? Yay, who doesn't love tax-free money? Things that are also a little bit tricky when you're dealing with rentals, mortgages. We got to talk about mortgages. Now, this is true if it's your primary residence or it's a rental property. The only part of your mortgage payments that are deductible are the interest, right? The principal repayment, never deductible. It's not deductible on your primary. It's not deductible on the rental. It's just the interest. So I've done videos before about how cash flow and profits aren't exactly the same thing. This is one of those instances where they're not exactly the same thing. So you do have to be careful that your tax profits are calculated a little bit differently. Other aspects of mortgage payments that could potentially help you if you're escrowing things like your property taxes, right? Property taxes, absolutely deductible. Any insurance, right? If you have like hazard insurance, property insurance, those are deductible on your rental properties. So you have to make sure that you're capturing all of your expenses. And a good CPA should review those expenses with you and ask you questions. I've had many times where clients come to do their taxes and they don't give me any insurance numbers. And especially here in Florida, I know you have property insurance. I know you're paying through the nose for it. It's expensive. Get that deduction, right? It's super, super important. Now, what else can make things a little bit complicated in real estate is if you're doing short-term rentals versus long-term rentals. Now, the reason this matters is, remember before I was saying how rental income is passive, it doesn't offset your W-2, it doesn't offset your business income. That is not necessarily the case if you're hitting the short-term rental loophole. So the short-term rental loophole is super, super cool because it does actually let you turn what is normally what is normally passive income with rental properties into a non-passive, and you can use it to offset things like your W-2, right? Your business income. So that's the big exception, but you have to be real specific if you think that this is what you're doing, because the short-term rental loophole has very, very specific guidelines that you need to hit. So the ones that we usually look at are, it's a 2-part test. It's a time commitment, 100 hours, and more than anyone else for the property owner, and that more than anyone else does include people like your handyman, your cleaner, your property manager, right? You still have to have more time in than all of those people, and the average length of stay, 7 days or less. Now, in Florida, we have a lot of restrictions in many places with homeowner associations that you can only rent, like, say, a minimum 30 days. Well, you would not be able to qualify for that short-term rental loophole if you can't have your average length of stay 7 days or less. So that is the big, big exception. That is a huge tax planning tool and opportunity. We use it with a lot of our clients. It is the way to say, oh, I have a rental property and I'm going to take the losses and offset my income. So if you need more information about that, we have other videos we talked about. You can also feel free to schedule a call with us. We'll go through it. We'll walk you through everything you need to do. But as far as the rental income, the big takeaways, make sure you understand the difference between the passive and non-passive. Rental income, almost always passive, unless we're talking about that short-term rental loophole. And document all of your expenses. Don't leave any expenses out. If it's related to that property, it is the best way to make sure you are paying the least amount of taxes possible. And then also don't forget, just because you're showing a loss doesn't mean it's going to offset any of your other income on your tax return. Don't be surprised. Don't come expecting a giant refund because you put a bunch of money into your rental property. Not exactly how it works. But rentals, not an easy topic on the tax side. You got questions, drop them here. Also, again, feel free to contact our office, schedule a meeting. We do this all day, every day. It's not so confusing for us. We can walk you through it. We can help you get your taxes filed correctly and keep out problems with the IRS.
Thanks for watching. If you found this helpful, please leave a comment, like, and subscribe. Stay tuned for more tips on growing your business and your wealth.